All right, so in this talk, we're going to be sort of zooming out even further. I'm sort of just going to be talking about platforms in general. In particular, in this paper, what we're going to be thinking about is the governance of traditional platforms, how that compares to the governance of platforms that issue tokens. Right, so traditionally, platforms have been governed according to the interests of shareholders. So, they choose how much to charge for their services, how much to invest, and so on in order to maximize shareholder value. And traditional platforms, usually don't issue their own currencies or other financial claims to users. Users don't necessarily have a financial stake in the system. And because it's a common concern with traditional platforms has been that there's too little alignment between the interests of the platform's owners and those of users. And in particular, the platform's owners might want to extract rents from users. Now, in the past few years, we've seen kind of the advent of platforms that issue their own digital currencies, usually called tokens, to users. And platforms that do this often argue that by doing so, they're somehow better aligning their governance with users' interests. And now there are many different types of tokens out there, and they can offer several types of claims or rights. So there are some tokens that offer claims on a platform's transaction services, so they can be maybe redeemed or exchanged for a specific service. And then there are other tokens that offer ownership features, meaning they give you a cash flow claim on the platform or voting rights in its governance. And what we want to understand in this paper is whether tokens can actually accomplish their goal of aligning platform governance with users' interests. And if so, we want to understand how they should be designed to accomplish that goal. In particular, we want to get at what are the roles played by issuing tokens with transaction services or tokens with some ownership features. So in this paper, we're going to answer these questions by sort of developing a model of an economy with a platform to study implications of token design for platform governance. In the model, there's going to be a conflict of interest between two constituencies: users who transact on the platform and investors who don't transact on the platform but are interested in investing and earning some monetary rewards from it. Okay, and our model is going to be general enough to capture three different settings. It's going to, we're going to be able to capture traditional shareholder-governed platforms, but also platforms that issue tokens. So first, we're going to look at platforms that issue tokens that give claims on transaction services only, which we're going to call service tokens in this talk. So you should think of users transacting tokens on the platform. Maybe you can redeem the token for a particular service, but it's still going to be governed by shareholders. So one example you could think of is a centralized platform that issues a utility token. Like for example, the Golan platform issues a token that can be exchanged to rent out computational resources on the platform. All right. And then we're going to look at the case of a platform that issues a token that has both claims on transaction services as well as some ownership features. And we're going to call these hybrid tokens. So in this setting, we're thinking about a platform where users transact tokens with each other, and investors are going to stake their tokens to earn some monetary rewards and vote on the platform's policies and so on. So an example of this is a proof-of-stake cryptocurrency that has on-chain governance like Algorand. But you can also think of something like Aave, which has some utility features, but you can also stake it to provide a liquidity backstop and earn some cash flows as well. Okay, so those are the questions we're asking. And now I'll sort of just get into the model. So first I'm going to go over the kind of general environment before I get to these three specific settings, which I'll analyze in a little more detail. So we're going to have a continuous time economy with a platform that's going to produce transaction services XT. And the platform's going to incur a marginal cost C per transaction and charge a fee FT per transaction. Also, the platform may issue its own token, in which case it's going to receive some seigniorage revenues. So the platform's profits are going to be FT minus C times X plus any seigniorage that it receives. All right. Now, there are going to be two types of agents, as I mentioned. And the first type of agent is going to be users who are going to engage in transactions on the platform. And they're going to receive flow payoffs equal to xt to the 1 minus gamma over 1 minus gamma, which is their utility from engaging in transactions xt. And then they're going to pay a fee, ft times xt, to the platform. All right, and in each of the settings we're thinking about, there's going to be a transaction asset that users have to hold in order to transact on the platform. We're going to note it's priced by Q and its supply by AT. Okay, and I'll get into the details of what's going to play the role of the transaction asset in each setting later on. And now the second type of agent is going to be investors. And investors don't transact on the platform, but they're going to hold cash flow claims on the platform. All right, in each setting, there's going to be a cash flow asset that they can hold in order to receive some passive dividend income. Now, the platform's governance is going to determine both how much it charges in transaction fees, as well as if it issues a token, it's going to determine the platform's token seigniorage policy. And the constituency, either investors or users, that controls the majority of voting power is going to get its most preferred policy. All right, and the way in which voting power is allocated, again, is going to be specific to each of the three settings. And these decisions are going to take place periodically over time. In particular, governance decisions are going to arrive according to a Poisson process with rate lambda. Okay? Now, really, the main thing that's going on here, the main endogenous object in this model is just the total quantity of transactions produced by the platform. So I'll get into how users' transaction demand is determined. And again, this is going to be the same across the three settings. All right, so like most models of platforms or macro models in economics with money in the utility function, we're going to assume that the quantity of transaction services received by a user, xt, is equal to their dollar holdings of the transaction asset, which is qt times at. All right, so users are going to choose their transaction asset holdings in order to maximize their utility, which is equal to their payoff from transacting minus the opportunity cost of holding transaction assets, which is the interest rate R, the foregone interest, plus pi t, which is the expected inflation rate on transaction assets. So basically, if the price of transaction assets is depreciating very quickly, it's costly for you to hold them. All right, and at an optimum, the marginal benefit of transacting on the platform, which is this service flow on the left-hand side, has to equal the marginal cost, which is the opportunity cost of holding transaction assets, R plus pi, times the quantity of transaction assets, xt. So the upshot of this is that when the platform charges higher fees, or when the returns on transaction assets are low, meaning inflation is high, then users are going to demand fewer transactions. All right, because both fees and inflation make it costly for users to transact. Okay, so that's the general framework. So now I'll tell you about how each of these three individual settings fit into the framework. So the first setting we're going to look at is a traditional platform. And in this case, the cash flow asset held by investors is just going to be equity shares of the platform. And all voting rights are going to be allocated to shareholders, so investors are going to be able to unilaterally choose policies. And for a traditional platform, the transaction asset held by users is just some asset issued outside of the platform, like cash, bank deposits, stablecoins, whatever. The platform doesn't issue any currency to users. Then we're going to look at a platform that issues service tokens. And this platform is still going to be shareholder governed. So investors are still going to hold shares and choose all of the platform's policies. However, in this case, the platform is going to issue a token to users that they can use to transact on the platform. And it's not going to have voting rights. So again, you can think of like a utility token, which you can redeem for a service, but doesn't allow you to stake or vote or anything. And then finally, we're going to look at what we call a hybrid token platform, in which case the platform just issues a single token that's going to be held by both users and investors. So users are going to stake the token, receive some cash flows, and get to vote on policies. And users are going to be able to transact the token with each other in order to get some utility. And the token has voting rights, so anyone, investor or user, is going to be able to vote on policies. Okay? So yeah, why might governance be inefficient in this model? The basic idea is that there's a conflict of interest between users and investors. Users want to maximize their own surplus. Investors want to maximize their own surplus. Nobody cares about maximizing total welfare. And in what follows, it's going to be useful to decompose welfare into three pieces. So total surplus. So total surplus is users' utility minus the cost of processing transactions. And we're going to break this down into the platform's transaction processing profits, plus users' service flows, which is the marginal utility of holding transaction assets times the quantity of transaction assets held, plus users' inframarginal rents, which is the remainder of user surplus. So investors care mostly about profits, whereas users care mostly about maximizing their service flows plus inframarginal rents, if they get to choose policies. Okay? I want to understand what type of token design is going to lead to efficient platform governance that maximizes total surplus. So first, we'll look at a traditional platform. And what happens in this case is kind of very obvious. So in this setting, there's just going to be a transaction asset supplied outside the platform at a constant price. And the platform's investors are just going to choose fees, and transaction demand is going to be decreasing in fees. So since the platform is a monopolist, investors are going to choose a fee that maximizes the value of the platform's equity, and the platform's going to, the optimal fee is going to be higher than the platform's marginal cost of processing transactions. All right, so of course in equilibrium, then fees are going to be too high from a social perspective, and transaction volumes are going to be inefficiently low. All right, because investors don't internalize how their policies affect user surplus. They care only about investor surplus. All right, and in a diagram you can see this pretty simply. So the downwards curve is users' marginal utility of transacting, and then this black horizontal line is the marginal cost of processing transactions. And investors care only about maximizing the area of this blue rectangle, which is their profits. So they're going to choose fees that lead to a quantity of transactions, denoted here by x trad, that is below the first best, and there's going to be some deadweight loss. Okay. And we'll understand whether token issuance can incentivize policies that take more of user surplus into account. Okay, so now I'll move on to talking about a platform that issues service tokens. Okay, and in this case, the platform is going to issue its own token to users, and users are going to transact this token with each other on the platform. All right, but still the token is going to have no voting rights, and investors are going to choose all of the platform's policies. Okay, so now, the main difference from a traditional platform is that investors receive profits from two sources. The platform receives profits from processing transactions, but it also gets seigniorage revenues from selling tokens to users. Okay, so investors want to maximize the present value of transaction processing profits plus seigniorage when they choose their policies. Now, users are going to value tokens, the same way they would value any other asset, according to the marginal utility that they receive from holding that asset. All right, and the marginal utility they receive is equal to the service flows that they get, and they incur a cost from inflation because that causes the depreciation, the value of the asset they hold. So as it turns out, the market cap of tokens, basically the price of tokens is going to be equal to the present value of service flows minus dilution from inflation. So because the price of tokens is linked to the service flows received by users, now investors have a reason to care about users' service flows. Basically, if users expect to receive high service flows in the future due to, let's say, lower fees, investors are going to be able to sell tokens at a higher price. Okay? So remember, in the traditional case, investors only cared about transaction processing profits. Now they care about users' service flows as well, since if they promise higher service flows in the future, they can sell tokens at a high price. So this is going to lead investors to promise lower future fees in order to get higher seigniorage revenues ex ante. So now investors want to maximize the area of these two rectangles, so will promise lower fees, and this will lead to higher transaction volumes than in the case of a traditional platform, but still below first best because investors still have no reason to care about users in for marginal rents. Okay? Now there's a problem with a platform that issues a service token though, which is that in order for the service token to be valuable to users, you need to be able to commit to low inflation going forward. All right? If you issue tokens too fast and their price is going to depreciate a lot, and the price of the token is going to collapse, and it'll be costly for users to hold it, so they won't transact. Okay? And what we show in the paper is that basically the service token scheme can enhance welfare only if investors have a sufficient ability to commit not to dilute the value of users' tokens through inflation. All right? So when they have strong commitment, this leads them to promise low fees, and this enhances transaction demand. But when they have weak commitment to future policies, then they're tempted to inflate away the value of the token, and this leads transaction demand to collapse. So what we want to understand is whether there's an alternative token design that can overcome this time inconsistency problem that leads investors to inflate away the value of tokens. All right? And in fact, there is. And what we show is that this hybrid token scheme that we analyze in the paper accomplishes precisely that. So instead of issuing a separate token to users, now the platform issues a single token that's held by users for transactions and is staked by investors to receive some dividends and vote on policies. All right? And since these tokens have voting rights, both types of agents can vote on the platform's policies. Okay? And what we show is that in equilibrium, the price of tokens has to reflect the welfare of both constituencies. So the price of tokens reflects the present value of service flows plus the platform's profits. Okay, and very quickly in last couple of seconds, what we show is that this hybrid token scheme overcomes the time inconsistency problem. Basic idea is that investors hold the same asset as users. So if they're going to pass policies that are really going to harm users, then the price of the tokens held by investors is going to fall. And this is going to protect users from policies that seek to extract rents. All right? So yeah, I'm out of time, so let me just conclude by leaving this slide up there. Thank you.
All right, you're at Carnegie Mellon. Those of you who are not economists, one of the most famous papers ever written here at GSIA then was called the Miller-Modigliani theorem, which is what a question I'm going to ask you about, which is the famous theorem from the 1950s about sort of capital structure of a firm. You can have as much debt as you want, as much equity as you want. It impacts a lot of things. It doesn't impact value. And so this paper is basically pointing out when you issue the right-hand side of your balance sheet, the structure of that right-hand of the balance sheet matters. So that Miller-Modigliani theorem, sorry, this is a long question just for the audience. Miller-Modigliani theorem sort of points out as a benchmark, what is it that we're, that's creating this need for where the design of these tokens actually matters?
Yeah, right. So I think, this is a super interesting thing that we kind of, discovered while writing the paper, which is that the Modigliani-Miller theorem doesn't apply in this setting because tokens are effectively a type of claim on future user surplus. It's not a claim on the platform's cash flows. So in this model, actually Modigliani-Miller holds, like you can tranche the platform's cash flows in any way you want, doesn't affect anything. What matters here is that the platform is effectively issuing an asset whose value depends on the future marginal utility that users expect to get from transacting on the platform. And we actually, so here I've shown you a very simple version of the model. We extend the model to have real investment as well, and we show that, in fact, the decision to issue tokens affects the platform's investment policies. In a sort of socially beneficial way.
Quick question. So in your model, does the inflation part incorporate the market expectation? Because we want, for example, like we have the Stepan, if you know that Solana project, it has already issued the hybrid token economics, but it kind of fell as well. So, but I would say the whole market expectation could influence your asset value. So from your part, how your model can address that issue? Thanks.
Yes, right. Yeah, so in the model, for sure, inflation depends on future expectations of price. It's a basically standard asset pricing model. There can be equilibrium in which the price just collapses. I mean, we don't think those are very interesting, so we don't, analyze those. But yeah, it can be the case everyone expects the token price to just collapse to zero. So we expect, inflation to be infinity. We don't demand any transactions. And other things can happen as well, right? There can be sort of more subtle things where we expect a drop in the price by 50%, so we demand fewer transactions today. So yeah, all of that stuff can happen in the model.
One brief question maybe. Who are you thinking about as the platform designer? So like, one interpretation of this is forget totally. I think about like airlines and airline miles, and they're giving me voting power as a mile holder on the policies about how we're going to redeem miles and what services we get from that. But I don't think about the airlines being like, we want to maximize user surplus. Yeah. So how do I think about the platform designer here, and why do we want to move away from market power where we think the people creating the platforms are the natural monopolists?
Yeah, right. No, so I think that's absolutely an important question. Like, would the platform designer want to do this? And in this model, the answer is actually, yes, they do want to do it because you get extra seigniorage revenues from selling the tokens. So, if the investors can sell a token, they will do so so long as they have enough commitment power. So basically, the case in which issuing a token enhances welfare, it also enhances investor surplus. So yeah, I mean, we didn't talk so much about this, but yeah, at the end of the day, if you allow investors to choose whether they issue a token or not, they do so precisely when it's good for everyone.
Very interesting. I think it's important we're making progress on tokenomics, where we seem to have a lack of guidance here, especially for applied kind of industry users. So thanks, Joseph.